Thank you everyone for joining. This is our first meeting for our new meetup group, which is Crypto for All. And as you all know, I've talked about in Saturday meeting, we've been talking about crypto for almost a year, but now just the crypto economy itself has become so big that we were not getting enough time. It didn't get all the time that it deserves in the Saturday meeting. So as I talked about, we need to have a meeting which is specifically on crypto and keep it separate from our stock and options discussion. And that was the genesis of this meetup group. And in Saturday meeting, I'm not going to talk of crypto anymore. We'll rather have all the discussions around crypto in this meeting. Okay. So for those who are new, there are many people who are still joining in. As always, in all my meetups, I'm not a financial or a tax attorney or a financial professional. So everything is only for our education and not an advice. So don't go and start trading based on whatever you heard or seen in this. Let's look at what's our today's agenda. Today we're gonna do an overview of blockchain technology, which is the backbone behind this whole crypto economy. Then I'll provide you what I have noticed in the crypto world for this week, and then we can break out into separate rooms. On Zoom, you should see an icon for breakout, and if you either click on it, or if you are attending it on a computer, on the menu you should see breakout, and then there are different breakout rooms. So we'll open up all those rooms once we are done with the crypto updates. And then if you want to go and have a smaller group discussions on maybe Ethereum, altcoins, DeFi, NFT, or is there any other topic on which you want me to create a breakout room, let me know. So I'll create a breakout room on that, and then we can have a separate discussion on those specific topics. So that's our agenda for today. Any questions before I jump in? And sorry, I'm focusing in between away from the camera because I got another screen. I'm keeping an eye on if there are any questions coming up or if there are people waiting in the waiting room. So that's all we're gonna do today. So if there are no questions, let's dive right into it. Yes, the recording is on. All right. So for today, let's look at what is a blockchain, the underlying technological innovation behind all this crypto economy. Right? But before we dig deeper into what is blockchain, let's first understand a little bit of a history of our financial system. Our whole financial system, be it brokerage, be it your banking system, be it any other, let's say lending, etc., everything is based on ledgers. Ledgers are nothing but system of record. If I transfer some money to you, in the end, eventually in someone's computer, mostly those computers are managed by banks, against my name or against my account number, the amount is debited, and against your account number, that amount is credited. Essentially, this is a ledger. And thus we know that I own less and you own little more. Whole financial system is just based on ledgers. We no longer carry the stuff along with, I no longer have to carry the cash and give it to you. And updates in the ledger, which are maintained by the banks, is a confirmation, is a proof that the transaction has happened. That's how whole of our financial system has been built. I would say the modern financial system. Earlier, we had to actually exchange When gold used to be the coin, or a few hundred years ago, when the stones, some precious stones used to be the store of value, we had to exchange those physically. But today's whole system is just changing the numbers in a ledger somewhere. And that ledger actually serves a record of who owns what. Today, if I claim I got $1,000 in an account, all you need as a proof is a letter from a bank which says, yeah, there is $1,000 maintained against my name in bank's computer system. There is no physical VAT or bills, $1,000 bills sitting there with my name on it. It's just an entry on a ledger. So that's how the whole of the system is already based upon. This used to be a ledger, 3000 BC. Little more primitive ledger. This was a personal ledger of George Washington, in which he would write whom he had given what money. While growing up, I remember my dad used to have his ledger where he used to write down the stuff. But now everything is computerized. Banks have computer-based ledgers in a very simplified form. All these ledgers that we now have are maintained by centralized institutions, banks. So if I were to give you a proof that I can pay this rent on time, you are my landlord, I need to give you a proof. I need to get a letter from a bank, because banks maintain the ledger up somewhere. Now everything is in cloud, which tells that against my name, there's some entry which shows, yeah, I have that money in my account. Or if you're dealing into stocks, you want Apple stock, I hold Apple stock. How do I prove it to you, or how do I transact with you? We have to transact through some central institutions, brokerage firms. Then it comes a DTCC, which maintains the record of who owns what. DTCC is Depository Trust Clearing Corporation. So brokerage firms or other institutions, again, those are centralized institutions. Each one of us has to go through them. Or if we are engaged in a transaction of buying or selling a house, we depend on government agencies. We depend on the recorders, county recording agencies, which have a recording saying Vivek is an owner of this house. Or if you own the house, they'll have a record that you own this house. And if I see the recording in the county office, then I'm certain that you actually own the house. The reason why we all have to go through these institutions. See, if I own Apple shares, you want Apple shares, we should be able to transact among ourselves. But we don't. We still have to go through the exchanges. We still have to go through the brokerage firms and exchanges. The reason is because we don't know each other, we don't trust each other. So if we don't trust each other, then we have built a system, the society has built a system in which we have appointed one agency, one institution, whom every other person will trust. And that institution has been designated to keep a record of who owns what, who owns how many dollars, who owns what stocks, who owns which house. And those institutions, they charge money for doing the record keeping business. Around 4 to 6% of a GDP is actually spent because of just this, the fee that these institutions collect to do this role is 4 to 6% of our GDP. So this is how historically our financial systems have been working. It works fine until it doesn't. In US, in developed countries, we don't see these issues. We have no concerns with banks or brokerage firms. We are happy with them. We have faith in them, and life is going good. Not everywhere else in the world. Not at all times. So what happens if these centralized institutions, whom we go through for every transaction, whom we depend so much on every transaction, actually go rogue? What happens when these intermediaries, they don't perform their role honestly? That's a big trouble for us. And we might be thinking, we haven't seen that happening. These are really trustworthy institutions. But we have seen recent examples. In Cyprus, unilaterally, lawmakers of Cyprus, they decided that because the economy of Cyprus was going under, the banks were having a lot of issues. They decided that everyone who has money beyond a certain amount, they have to forfeit almost 50% of it to government. And this happened in 2013. We're not talking about 50, 60, 70 years ago. It's like 8 years ago. So imagine someone working throughout their life, build up their retirement account, and wakes up to figure out that it's been cut in half of no fault of theirs. So there is no other record of what they own. Now, if you log into your account, you suddenly see that the account balance has been cut into half. We saw another one. What happened to some Russian dissenters? Now, in this case, the institutions colluded with government. Again, I'm not getting into the politics of whether it's right or wrong. We're just trying to look at the problems that people get into if those central institutions, either by actions of their own or being coerced by someone else, can do the things that can mess up with your accounts. So in this case, some of those Russian dissenters suddenly find themselves 1.2 million in debt. Banks change the numbers in the ledger against their account numbers or account name. I mean, in a very simplified way. But these things happen. These things happen even in today's world. In many places, in many countries in the world. So, if we are dependent always on a centralized institutions, then it works till it stops working. And when it stops working, there is no other way out. And this was the whole concept on which Bitcoin surfaced in 2009, which was, hey, every government is now just printing money. We are in a financial mess. We need something that is not controlled by a centralized institution. That was just one use case. And now that use case has become much bigger. So in today's discussion, we're going to look at what's the technology behind it. Again, it's not going to be a deep dive into tech. I'm not going to get into the details of cryptography. I will talk about it. I will try to share the information in a as much as non-technical way as I can. But since this is a technical topic, this came from a technology, we have to be a little bit comfortable with some of the tech words. So what's an alternative? If you don't want to have banks, if you don't want to have these centralized institutions, what alternatives? You have an alternative which is natively digital, and it is controlled and managed by an individual owner and not by an institution. One question that I get asked is, we are already digital. I have PayPal, I have Square, I have Alipay, in which I can actually transfer money to you. You give me your PayPal ID and I can transfer money to you. But if you look at the various layers in which a financial system works, so PayPal and Square are a digital way to again update the end ledger, which is being maintained by banks. The topmost ledger is maintained by Federal Reserve. And then there are commercial banks which maintain the sub ledgers. Because where every dollar goes, your Federal Reserve has to know. And then the commercial banks have got the sub ledgers. So what PayPal, Square do in US, when I'm transferring it to you, it's only an indication that we need to update those ledgers. If I'm using my bank account to pay to your, and your PayPal ID is connected to your bank account, eventually the balance will be changed in the bank accounts. So they are, I would say, a method of updating that end ledger. Okay. So an alternative is to have a way in which the money is digital and we as an individual control it and not a central institution. There have been previous attempts. Bitcoin is not the first one. There have been attempts to solve this problem, to bring something which could be of value, and that's what money is. It could be dollar or whatever. Give whatever name we want to give. And few hundred years ago, it were gold, piece of gold that was a value. No paper dollars. So, but anything of a value, how to have a pure digital way in which the owner has a control on it. There have been previous attempts. And some of these people are even active in Bitcoin community also, but they try on their own. Few names that stand out for me is Adam Back from Hashcash, Nick Szabo. They're still active in this community. But none of them had succeeded because they were not able to figure out that if we make it digital, how do we avoid the problem which is called double spend? Means I should not be able to spend the same money twice. If I'm a buyer, how do we ensure that I'm not sending the same dollar to two people? Today, information is already been digitized. It lives digital world. It lives in digital world. But there is no harm in, or I would say, if you double spend the information, if I have my photograph and I want to share it with two people, it's perfectly okay. I'll just create a copy, Control-C, Control-V, and voila, I have 2 copies of my photo. But we can't do that with money. And then the whole system will collapse. Then there is no value in it. So this double spending is a huge problem. How do we, if as an individual, if as a buyer, I am in control of what I own, and how do the system ensures that I'm not copying it? I'm not doubling or trebling, I'm not copying the same money I have multiple times and keep spending it. So these previous attempts were not able to find a solution to this double spending problem. So as a solution for all the problems that we talked about, which is a centralized system gone rogue. What do we need? Or a problem of double spending. We need a decentralized ledger system. Means eventually everything needs to be recorded, so we will have a ledger. But now it is not controlled by one central authority. That is why it is called decentralized. No single party controls it. You cannot add or delete, or you cannot add any transactions without having a proof of ownership. So for example, the ledger, it is decentralized, no one controls it. It means if I'm holding that ledger, I could go and make a change in the ledger. I can add a transaction that I earned X amount of dollars or X amount of Bitcoins. But I will not be able to do that unless there is an actual proof of ownership is established. And this is where the technology comes in. And that ledger has a timestamp log of all the transactions that have ever happened. So I transfer it to you, I owe you a few dollars, or I owe you a Bitcoin. I add an entry saying that from Vivek, move this Bitcoin to, let me pick up a name, to Alec. Alec, I hope you're okay with it. Do let me know. I will try to pick up some name here where I'll give an example. So if I were to move, I owe something to Alec and I need to send it to Alec, I'll probably push a transaction saying move or this Bitcoin from or dollar or whatever, or something of value from Vivek to Alec, and I just need to record the transaction. So now I will be able to do it only and only if there is a record in that ledger that I actually have Bitcoin against my account. So some point of a time in past, there has to be one entry which says Vivek received a Bitcoin. Vivek received a Dogecoin. If that fancy you, well, that's nowadays a very, it's in news. So let's talk about Dogecoin. So unless there is an entry which says Vivek has the Dogecoin, I cannot, add another entry in which says removing from Vivek's account and then adding it to Alex's account, because I never owned it. And then I also have to ensure that I provide my consent by digitally signing it. So that becomes a proof of ownership, means I am signing it. It's a equivalent of a signature on a check. And now once that record has been added, it is immutable. So it is append only. Now those who have been active probably can come and say, oh no, but we have had cases wherein we had to go back and make a change. I agree. During the initial days of this whole crypto economy, systems were not perfect. So we made a mistake, learned from it. We got Ethereum and we got Ethereum Classic. That's why we got two variants of Ethereum, because we had to make a change. At that point of a time, the Ethereum organization or Ethereum society had to break the rule of immutability. Story for some other time on why it was to be done. But this whole blockchain based on if you add it, it becomes immutable. So now, if I'm having a record of who owns, say, a piece of land, then if that record is kept on a blockchain, that becomes immutable. You cannot go back and modify the previous block. So we'll talk about it in terms of why it's so difficult. So it becomes append only, keep on adding the new stuff. And because this is decentralized, how do we keep everyone honest in this? There needs to be a way to enforce an honest behavior so that the rogue participants who are participating in this system, who have taken upon the responsibility of adding transactions in this ledger, they behave honestly. And it becomes more difficult if we don't know who is participating in it. Imagine the copy of ledger, everyone has a copy of ledger, and now they can record whatever they want to. But we have to find a way to make them honest. So that's where the blockchain and the network consensus protocol, which is all put together by Satoshi Nakamoto in an application of a blockchain called Bitcoin. That's where all things came together. He, she, they, nobody knows who is the inventor or inventors of Bitcoin. But that's where the pseudonym Satoshi Nakamoto presented a white paper saying, this is how we can do electronic cash. Again, at the end of the day, cash is an entry in a ledger. So from Satoshi Nakamoto point of view, the thought process was, hey, let's make sure we have an alternative way of cash or currency. But that's not the only application. That was the first application. It's like, if we're thinking of internet, let's find a way to communicate with each other. Hey, email is the first application. But that's was the first one to begin with. And then we have had many other use cases of using internet. So Bitcoin was the first application in which blockchain was used. This whole concept was used. Some of these concepts, some of the technical concepts within the blockchain have been borrowed from a previous attempts. I would say most of them. So the biggest contribution of Satoshi Nakamoto was to bring all of these things together in a sequence and create this enforce this honest behavior. That's where, that's where he gets the whole credit of creating this Bitcoin network. All right, if you have any questions, please put in the chat window and I'll address it as we move along. So what is blockchain? Blockchain is a blocks. So these multicolored, these are the blocks which are chained together. And that's where the name comes from, blockchain. So now these blocks, now this is a big ledger. Now these blocks have information in them, and we'll get into what kind of information do they hold. But this is the whole ledger, which everyone can see it. It's auditable. It's open. I cannot go and look at a bank's ledger. I can only look at what my account is. Bank's ledger is not open. But there's Bitcoin ledger, which is built on blockchain. It's open. Anyone can go and see what's contained in each account. Now it's open, but you can't hack it. It's been secured again by using I would say cryptography techniques. And then because it is open, multiple people or I would say computers can update it, how do we make sure that those stay honest? How at least more than one half of those people stay honest and are in consensus with each other that we got to do the right thing? That's the protocol of a network consensus. The combination of this is what entails the whole blockchain. So let's look under the hood of what this is. I see a question. Is the blockchain trimmed after X years? For there have been a different blockchains in which some of the data has been moved out into a separate data, but on the Bitcoin side, I think, or on the Ethereum side, I can't recall which one it is. But net will still be in a blockchain. How it is streamed, etc., without getting to technicalities, we should still be able to go back and look at the very first transaction that has happened. And I will give an example. I'll actually look into the Bitcoin blockchain and we'll look at the very first transaction that happened in 2009. So how is all this possible? So there are, I would say, two concepts that you should keep in mind. And probably this is as technical deep as I will go while talking about crypto economy. One magic is something called hash, and this is the magic which our computer scientist community has given us. What hash does is you can consider it as a black box. You can input anything in that black box. What comes out is a fixed width, a string. Let me put it this way. So I can put this presentation in this black box. What I'll get is, let's say, a 256 character long string. You can put a book in this black box. You'll get a 256 character long string. Again, there are different hash generators. But the idea is, I can put a Netflix movie in this. I can put whole Britannica encyclopedia in this. And in the end, I will get 256 character. Now, each of these 256 characters will be unique and different. So for you and I, we have to compare something without showing you what I hold and what you hold. But the only thing we want to check whether we are having the exact same things is just to put both of them in this hash black box, see the output, and you put it, see the output. If the output matches, it means what you and I hold are exactly the same. If anything has been tampered in that, it means it is different. So let's just look at this example. Or let me just go back to this hash generator. So let's look here. I can type in anything. It's got 56 characters in this. Let me just copy and paste something from a Zoom screen. It'll give me another. This is called hash string. So you can add anything in this. It will always give an output. This is called hash value. Now, beauty is if I change anything in this, if I just add a decimal, this thing is entirely changed. So this is one property which play a huge role in Bitcoin. It also, this is nothing new. This is being used in our current systems already. So this is called hash. That's the magic number one. Another, and the last one from a technical perspective. is cryptography, the magic of cryptography. Paul M says 250 is big, 32 bytes, 64 hex digits. Oh, I don't know. I mean, I probably might have misstated that it's 256 bits, but the concept is you'll get a fixed length depending on whatever the hashing algorithm is being used. Again, this is not, I would say, a technical session. I would rather fail if I were to explain exactly in the computer science way. If there is software engineers and the computer sciences will probably be fuming that I said an incorrect thing. Right now, I'm just trying to explain the concept. And this is for the retail investors. I don't have to get into the details of how exactly it works as long as I understand that what hashing does. So second is your cryptography. And now this, if you are already dealing in the Bitcoin or any other crypto coin, you probably have already gone through this. So this is an open wallet in which is a public and private key concept. Everyone can look at my public key because I tell them, deposit your donations in this box. There's a name on my box. Please deposit your donations over there. But only I can open the box because I have a private key. Anyone can deposit in this because my public is known to everyone. I have shared them, but no one can take the money out of it because they don't have a private key. Or let me put it other way around. If anyone has got a private key, I lose my private key, then it is as good as I lost everything which is stored in this. That is why you might have heard that people misplace their keys. And now they can't get to Bitcoin. Even government can't get to Bitcoin. Now, along with your independence, that I want to be owner, comes a huge responsibility that yes, I will take care of my things. So if you lose the key, it's gone. It's already, I think some percentage of Bitcoin have been considered to be lost forever because the owners have lost the keys. There's no way now anyone can go back and recover it. So this strong way of a cryptography, this whole infrastructure of private and public key, that's another technical, I would say, term. Just keep in mind, no, because we're gonna now talk about it, how it's get used. So going back to blockchain, it's blocks which are chained together. What is in the block? The block has got a list of transactions. So say you and I, we all keep transact. I want to send it to you, you send it to someone else send it to someone else. So many transactions happen. We put in a block all those transactions. Now, every block not only has the transactions that have happened since the previous block was created, but it also has some information about the previous block, which is a hash of the previous block. So it means when I create block 1, I put this whole block 1 into this hash generator. It'll give me that fixed length string. I will put that fixed length string into block 2. Then I'll add a new transactions that are coming into block 2. Again, simplified view of how it happens, not getting into the details of the Merkle tree and all that stuff. But just understand each of the block has got what transactions have happened since the previous one was created and an information which identifies the previous block. And then block 3 will have a new set of transactions and the information which is a hash of block 2. Now remember, block 2 So block 3 has got a hash of block 2. Block 2 has got a hash of block 1. So 3 is tied to 2 through this hash, and 2 is tied to 1. So this is how all these blocks are actually chained together. Every subsequent block have an information about the previous block. And that block has an information about a previous block. And that block has got an information on the previous block. So this is why it is called blockchain, because the transactions are put in a block, and those blocks are now chained together. So another representation, for example, block 0, we got all the transactions for past 10 minutes. We create a hash of it. Again, this hash will be depending on whatever the algorithm is used in different crypto projects, could be of a different size. When I create the next block, this hash goes in here. When I create a next block, the hash of a previous block goes in here. So now if I'm a rogue person, so let's say in the block 1, I send a transaction saying from Vivek to Alec, move whatever this blockchain is based on. If it is move a Dogecoin, let's say this is a Dogecoin's blockchain. I put that transaction in, and the system will check if I ever had a Dogecoin in my against my account, or against my address. If yes, then they will allow this transaction to go through. Now, say later on, I come back and I am the one, because it is open ledger, anyone can modify it. I'm the one I'm like, let me go back and modify this block and say I didn't send the transaction, or change a previous one to say now I got 2 Dogecoins. If I change this and I tell to everyone, hey, this is the correct chain of blocks, then I also will have to change this, because the block 2 has got an information of block 1. Because I changed block 1, this hash will change, and the new hash needs to be added here. Sorry if it is getting too technical, but this is a very important concept to understand on how it is secured. So in the non-technical terms, every block is tied to each other. If you try to change one block in between, you have to go and change all the subsequent blocks. Okay. Now, when we talk about network, there are hundreds or thousands of participants. This whole blockchain is stored not only just with me. The complete blockchain is also with 10,000, 100,000 other participants also. Those are called nodes or miners. There is a difference between them, but not getting into the details. But those are called blockchain nodes that exist throughout the world. Now, all of them have a copy of it, the whole blockchain. So each one of those hundreds of thousands have a copy of this ledger. That is why it is decentralized ledger. If a few thousand of them die down, it's still okay. I can still find out how much I own. There's still a record of it. If Bank of America system is corrupted tomorrow and they are not able to recover it from their backups, I'm doomed. No one else has a record of that account. So let me address some of the questions. Let's look at the question. I'll come back to this. Is there a limit of amount of transactions that a block can store? Yes. Each block is of a specific size. I think block in the Bitcoin is 2 MB. On other cryptos, the size is different, but it can only store an information up to that size, which means you can only store a limited number of transactions. Steve asks, is a hash generated concept similar to where Bitly compresses the long URLs into shorter versions? Okay. Oh, Alec is trying to respond. Yeah. So how hash actually works, I don't know. Probably NSA might know. I think the SHA-256 was generated or created with NSA. I don't know. All I know is it'll give me a fixed width string. Question: how often are blocks added in Bitcoin? It's every 10 minutes. So Bitcoin network, again, today we are talking about blockchain as a concept behind thousands of these crypto coins. But I know about a Bitcoin. I can talk about Bitcoin. Bitcoin block is generated every 10 minutes, approximately 10 minutes. The network is smart enough. The whole Bitcoin core software is smart enough that if you add more and more computing power to generate it faster, okay, I'm running out of muscle. We'll talk about it, how it gets generated. And then the logic changes that you can't suddenly create, Bitcoin every minute. So that is why we already know how many Bitcoins would be created today, tomorrow, 5 years later, 10 years later, 20 years later. And based on that projection, that is why we say is all the Bitcoins that will be created will be done by 2140. After that, no more Bitcoins creation. One Bitcoin is created every 10 minutes. A block is added every 10 minutes. And when a block is added by these nodes who are called miners, they get rewarded because they have to do some work to add that block in the chain. And for doing that work, no one will want to do a work if there is no reward. This is a capitalist society. That's where the beauty of Satoshi Nakamoto is. He figured out the whole way to keep these miners honest and reward them for their honest behavior. So these nodes, when they add a block into the chain, they get rewarded by Bitcoin. That's how the Bitcoin is actually created. Because miners are doing the work. It's like when the gold miners, they gotta do the work to mine the gold. Similarly, Bitcoin miners had to do some sort of a work, and we'll understand what kind of work that is. And they get rewarded in the form of Bitcoin. That's how Bitcoin is created. And a ledger, it is decentralized because thousands of participants have it. They all have a copy of it. You make any change and I don't have it, I would say, not correct. Sorry. I didn't have that entry in ledger. You trying to change an entry like 5 days earlier. I would say, no, I don't have that entry. I reject yours. And that's why it's difficult to tamper with blockchain network. So let's understand the whole, how the transaction happens if we are trying to transact. So Rob opens a Bitcoin wallet, and again on a software is so cool. I mean, we don't have to, you and I as an end user, we don't have to worry about cryptography, worry about a hashing, etc. Everything is taken care by the wallets. So if I were to transfer anything, I open my wallet on my laptop. Basically, it's a piece of software. And in that software, I'll give the address. Consider it as an equivalent of an account number in a bank account. That address, you will tell me what's your wallet address. You'll share that with me. I'll open my wallet, my software, say to this particular address, send this Bitcoin, or this is the amount that I want to send. And then I press send. Then my wallet will sign with my private key. So remember, if you go back, private key is something which will give or authenticate that yes, I am the owner of this transaction. So that transaction then goes to the blockchain Bitcoin network, and those thousands of nodes, now they pick up the transaction. Now they're trying to, and they pick up a lot of other transactions that have happened in last 10 minutes. A block is created every 10 minutes, approximately 10 minutes. So since the previous block was created, now for next 10 minutes, these miners will keep collecting all the transactions, put them together, put a hash of the previous block in that. But now there are thousands of miners. Who gets to add that block in the chain is based on some work that they have to do. It's a race among the miners because they want to get rewarded. Plus, in every transaction, I also tell them, if you add this into the block, I'll pay you some fee. So they want to get paid fee, and they also want to get the reward. So all miners are racing against each other. And then in term it's called, they solve a mathematical puzzle. Again, that involves more technical discussion. Is they need to get a hash in which some numbers need to be zeros in the front. Little more complicated, so not getting into that. But from a conceptual understanding perspective, they all of are racing against each other to solve a computerized mathematical puzzle. Whoever solves it first shows it to everyone. I solved it. The beauty of a puzzle is, doesn't matter how complex the puzzle is, it's easy to validate. Now I get puzzle for my kids which are got 2,000 pieces. It will take them a few days to do it. But if I walk across their room and see, I'm like, yeah, done. Very easy to validate. So similarly, whoever the miners solve the puzzle, says they broadcast it to everyone saying, I solved it. Everyone look at, yeah, it's valid. The block is added to the blockchain. That miner gets the reward. A new block, new Bitcoin is created. And that miner gets the new Bitcoin. Today, one Bitcoin is at, say, around 50,000. Today, when a block is added, miners are rewarded 6.25 Bitcoins. And now this award or reward is halved after every 4 years. That process is called halving the reward. When it started in 2009, it used to be 50 Bitcoins. Then it became 25. Then it became 12 and a half. And in May, I think it was May 2020, now it is 6.25. 2024 May, the reward will be 3.125, whatever, 6.25, half of that. And that is why we know that every 10 minutes, how many Bitcoins will be created, and hence able to project that when all the Bitcoins will be created. So now that block has been added to the chain because he solved the puzzle, showed to everyone, looks good, added. Now all those 1,000 nodes, they'll pick up the new blockchain, which has got the latest block. And next 10 minutes, all the transactions coming in, the whole process will start again. So now, if there's a rogue party, I become rogue, and I have to modify one of the old block. I have to modify it on at least 51% of these thousands of nodes. Not only mine, because if I can always change what I own, I can change that ledger, but the moment I try to transmit that ledger, all other will say, sorry, I don't have that. Not matching. So this whole consensus works if at least half of those um, nodes agree with you, then that becomes truth. Now, if you were to make any change, you want to temper it, you need to temper it to the at least 51% of the nodes. This is called 51% attack. So if any malicious party want to make unauthorized change, not only you have to do on your computer, you have to do it on the majority, at least 51% of the computers. Means you need to have so much of a computing power to go and make changes everywhere else, hack everyone. So it is technically it is possible, but it is prohibitively expensive. That is why Bitcoin blockchain has never been hacked, at least as far as my knowledge goes. This probably is the biggest, bullseye for the best hackers in the world. But it's so expensive that it hasn't been hacked ever. It is virtually tamper-proof. And so net, what is a blockchain? It's an open ledger. It's like a spreadsheet. It's just got entries. Who owns what? Ledger of transactions. It is public. We'll have a debate on some of them are public, some of them are non-public. The technology is allowing you to make public. Now you can say, oh, not everyone can participate in this node. Not everyone can become node. I'll become node. I'll nominate Barrett, John, Ken, and Liz to become node. That becomes non-public blockchain because that's only limited amount of participants. It's called ledger of transactions. Anyone can inspect the transaction, which is again, people say blockchain is opaque. No. So let's look at Satoshi Nakamoto's account. Okay, this is a, come on. Oh, it's not able to click. Okay. So let's look at Satoshi Nakamoto's account. And this particular page I picked up. So multiple transactions have happened on his account. This was the first transaction that happened. This is one of the account or this address. There is no names in this. So it is pseudonymous. If I own a Bitcoin, my name won't be there, but a number would be there. Or in this case, an alpha, combination of numbers and the digits, or numbers and alphabets will be there. So this was done in 2009 when he first time he created the first coin. You want to go back and see? You can see all the transactions that have happened on this account. So beware, I hope none of us do it. And when trying to do any nefarious activities, FBI sees it all, NSA sees it all, government sees it all. This is not anonymous. It is pseudonymous. They know your account. They can find out exactly what has happened on your account, where you moved money, where you got money from. So it's open. Anyone can see it. When 2020, when the Twitter hack happened, I had fun in trying to do a little bit of investigation to go through that Twitter hacker's address and then figure out where he's moving money and those Bitcoins. So it was a little fun. Like whoever that person was, he made almost 11 pages worth of transactions, try to send all the Bitcoin that is received into multiple other wallets. But anyone can do it. Anyone can go and see what exactly has happened. So why it could change the future of transactions? The blockchain, not Bitcoin. Because it has a potential to disintermediate trusted third parties from everyday transaction. I don't need to trust any single intermediary. It's open. All the miners are working towards it. Some of them go rogue, still okay. They won't be able to modify the blockchain. So it is important whenever you are trying to analyze any crypto, first thing I need to check is how big is their network. So these new coins keep coming up, right? Every other day, Shibu, Ina, and Safe Moon and whatnot. If their network, the number of participants in their network and the amount of a computing power that they are using is small, then any company can build up a bigger rig and then change the ledger, because now they will own more than 51% of the power. So one day you own million Shibu Ina, next day all the transactions have been reversed, because the network is so small that even you don't even need a state sponsored attack. So be careful when you're trying to analyze any projects. It started with a single use case. Ledger holding entries for an asset. That was a Bitcoin was the first implementation of a blockchain. If you actually look at it, blockchain, the first use case was way back only outside of a computers. But within this context, it was the first implementation. Once we figured out that how we can change the entries in a ledger about anything of a value, then more ideas started coming in. If you don't have to depend on a centralized authority for trust, then can I change that entries in a decentralized ledger based on the logic? That's where the smart contracts started coming up. That's where the Ethereum started saying, why only change an entry? Let's add some little more logic to it. And then once those started coming in, we started looking at multiple other use cases. Remember, I gave an example earlier that I own Apple shares, you own Apple shares. Today we have to go through exchanges because DTCC has an account. Now, if what you own, I own, is on a decentralized public ledger, on a decentralized exchange, when I'm signing a transaction which says, send these Apple shares to Liz, I sign it with my private key. So it means I am authorized owner of it. You don't need DTCC to tell me that Vivek owns those Apple shares. Because I have a private key of that wallet, which has got the Apple wallet, it means I own it. If my kid has got a private key and he does it or she does it, it's for if my dog got it, they'll be able to do exactly the same thing. There is no, the identity or my ownership is asserted through that private key. So if that case, then you and I, we can interact and do an exchange of assets among ourselves without a central intermediary. So that's where we see a lot more use cases coming up. If I were to give a loan to you today, I put my money in a bank, Bank of America, and you get a loan from Bank of America. Bank has no money of its own. They are taking money from me, from a depositors, and loaning it out. But now with this, you and I, we can transact each other directly. I can loan you money directly. You don't have to worry about it whether I own that or not. It is available on public ledger. And when I sign a transaction saying, yeah, give you money to you, and that is cryptographically secured, there is no doubt about it that I don't own it. So any and every industry that has these intermediaries, they will be disrupted. And that's the end of a blockchain. Let me look at some questions, and I'll also open up the breakout rooms. If anyone wants to go and have a separate discussion, go ahead. And meanwhile, I will now go through some of the news that caught my eye in crypto world. Let me go through some questions meantime. Miners who Coinbase folks, no, Coinbase they want, they can start their mining operations, but I don't think they actually mine. Coinbase is working as a centralized exchange. It's not a decentralized exchange. It's a centralized exchange into a decentralized world. Okay, Alec, okay, he already answered the Steve's question on how to become a miner. Yeah, there are many. So from a miner perspective, if you don't want to become a miner because, hey, I'm not technically, I don't want to get into building a rig and running it and all that stuff, there are mining pools that you can join. I will contribute my dollar to a mining pool. Similarly, a lot of other investors would have contributed their dollars to the mining pool. And when the owner of the mining pool, when they successfully mine a Bitcoin, they mine a block, I should say, correct is mine a block, they get 6.25 Bitcoins in reward. Then they distribute those rewards to those who have contributed in that pool. Questions and concerns around energy consumption, we'll talk about it. All right, so that finishes our quick discussion on blockchain. Let's jump into the crypto roundup. Break rooms are open. If you want to go and have a separate discussion with your friends or anyone else on specific topics, go ahead. I will stay in this main conference room and talk about some of the things that caught my eye in blockchain world. There we go. There was a question around energy consumption. So this yesterday came along and kind of a little bit caused concerns in the crypto market. They're saying Bitcoin fell down because of this. Whatever. I don't want to focus on day-to-day fluctuations in the prices. A tweet from Elon Musk was, we don't want to accept Bitcoin as a form of a payment for Tesla cars, or because it is energy inefficient. My take on this is, I mean, Elon has got followers. He is a great master of, diverting the attention. Yesterday, there was also another news. The Tesla had a very bad performance in China in selling cars in April as compared to March, almost close to 30% down. Media is not talking about it. Why? Elon throws up a new bait to media. No, everyone is not, CNBCs, everyone is only talking about Tesla. When it comes to Tesla, all they talk about is around Bitcoin. Have seen this with Elon earlier also. When you want to divert an attention, it'll come up with something. But anyway, I don't want to dismiss it completely. But the fact is that there are concerns around that many of these miners, when they are racing against other miners, they have to have more and more computing power, which means they need to spend more and more electricity. The concern is many of those miners are using electricity generated by coal-powered power generation plants. So you burn more coal, not good for environment. Okay. The concern coming is many of these miners are actually burning coal. What is truth? Nobody knows. There have been some studies. There was one study done 3 years ago, wherein it was pointed out that most of the Bitcoin miners use coal. There are other studies that have been done after that. The recent one came from ARK Invest and Square, a joint study, which actually showed data saying why Bitcoin mining is healthier for environment, because it encourages a lot of renewable energy, harnessing of renewable energy. The report came in, we talked about it in one of our Saturday meeting before, when we used to discuss crypto in the Saturday meeting as well. And Elon Musk gave them a thumbs up, said, agree. And now suddenly it says, Bitcoin is not good. So this has been debated all over. There are viewpoints. No one knows what exactly the data is. It is difficult to find out. You can find out which miners are where, but you cannot exactly pinpoint which miners are using. Some number says that 40% of Bitcoins that are being mined use renewable, and 60% is not using renewable. We don't know what the truth is. But the fact is, none of the customers were probably waiting to sell their Bitcoins to buy Tesla. So it didn't matter from that perspective to Tesla anyway. So I'm like, okay, diversionary tactics, seen that earlier. I'm not going to pay much attention to it. I'll address the questions later on. Let me just quickly go through this. It might take 10, we might run 10, 15 minutes over if that's okay for you. I'll hang around. I'll stay. So if it's okay for you, then we'll go through it. What other I saw yesterday? MoneyGram. So they said they'll allow customers to withdraw cash from their cryptocurrency holdings. They tied up with another company called CoinMe. CoinMe has got ATMs, kind of an ATM in which you can go and either buy a Bitcoin by putting dollar. Now MoneyGram saying they'll tie with this. So on all the MoneyGram locations, you can go, and then if you have holding a Bitcoin in your wallet, you can use that CoinMe ATM in MoneyGram location. I don't know if they're gonna do ATM or they're gonna tie up and build a new product in which you can withdraw cash at MoneyGrams. Next one, this is a big one. Could become a big one, that FIS, which provides a technological solution to various banks. So most of these big banks, they have their big tech teams to build their banking systems. Top 5. All the other smaller banks, they don't have a wherewithal to have a big tech team to keep up with the technology. So they all get a technology from different service providers. FIS is one big tech service provider to these banking, to banks. Almost 300 million accounts runs on FIS platform. So they're tied up with NYDIG, which is very active in crypto space, to provide a solution, add a solution in FIS that if you want to buy a crypto asset, you don't have to open an account with Coinbase or Kraken or Gemini. You already have your bank account. And if that bank is using FIS system, you will be able to buy it from after logging in your bank account itself. So if this partnership works well, then it's a matter of time. Once banks become comfortable, they'll open up, buying and selling crypto right from your bank account itself. And this will also enable a lot of folks who don't want to open an account in Coinbase. I don't know what that is. Kraken looks very different, but I trust my bank. So those people can get access. We'll see how many banks pick up on that, but this was one big news. The tie-up between NYDIG and FIS. Others are general. A lot of the big banks, they all want to give crypto products to their customers. UBS was in news. Citibank is considering crypto services because they are seeing a lot of their clients are asking for it. Goldman Sachs, they reopened their crypto desk. They actually closed their crypto desk in 2018. Now they reopen it. They're saying, we need to start trading in Bitcoin derivatives. Our wealthy clients are asking for it. They are investing in companies which operate in this space. S&P launched crypto index. We have S&P 500. S&P is launching Bitcoin index, Ethereum index, mega cap index. What next? I also noticed that some of the one miner, Marathon Digital, now they're trying to address the concerns of ESG. Now, some funds, and again, I think at a core level, I think this is just a window dressing. But if that enables a lot of funds who have a mandate to invest in ESG friendly investing vehicles, they will be able to bring in Bitcoin. The story here is Marathon Digital is a miner. What they are saying is we will stop mining the transactions that are coming from a sanctioned list, like OFAC list. So we will only include the transactions that have originated from the addresses that are not OFAC. So this of course address the crime concern, but similarly, you can also look at a Bitcoin and say which miner had mined that Bitcoin. And then you can say, you know what, I don't want to buy a Bitcoin which has been mined by a mined by a miner who is operating in China, where we claim that those are running, using electricity powered by coal. By the end of the day, a Bitcoin is a Bitcoin. It's fungible. It's not different from anything else. But I would say that this is kind of a window dressing. And I'm sure there will be funds who will come up with these products saying green Bitcoin. We will not sell you the Bitcoin. We'll look at where the Bitcoin was mined and who mined it, and those miners are using renewable energy. And if that helps some of those funds or institutional funds who have ESG mandates to put money in Bitcoin, so be it. I'll take it. So VanEck file Ethereum ETF application for Ethereum ETF. There are already 8 applications for Bitcoin ETF waiting on SEC, but we got the first one on Ethereum last Friday. Canada has already approved 4 Ethereum ETFs. US has approved none. Galaxy Digital, there was an M&A. Only thing is the deal is over $1 billion. Doesn't matter who by whom, but the fact that now in this crypto space, we are having deals which are worth $1 billion means the market is maturing now. And of course, we saw PayPal and Square and their results and what they're planning to do with their crypto adoption. PayPal has got checkout with crypto anyway. It's available for all the US users. They also launched crypto on Venmo as well. Now they're also holding talks with Ava Labs on creating a stable coin, because we are seeing the usage of stable coin is growing by leaps and bounds. PayPal doesn't want to be left behind. Another company, Mogo, it came into news because now they're holding ETH on their balance sheet. So we know many corporates are holding Bitcoin on their balance sheet, but now we are seeing companies started to hold ETH also on their balance sheet. This is one company. There was another company, Meitu, from Hong Kong or China. They also are holding ETH on their balance sheet. This week we saw Palantir talking about Bitcoin. They say now we accept Bitcoin as a payment, and adding Bitcoin to the balance sheet is on the table. eBay. We haven't talked about NFTs, but if you're a little bit active, there's an NFT craze going on. So eBay says we'll also be able to sell NFT. And then Visa, in their earnings, they laid out what's their priority in crypto area. So I'm seeing a lot of institutions continue to be active and increase their activities in this space. It's not going to go away. I mean, the world will change, like it or not. You can ignore it, but it will change. I mean, when internet came, just imagine that this is of internet of early 1990s or late 1980s. Things are being built. Companies are building solutions. Soon, you will start interacting with it. So either jump on it now, try to understand, or anyway, it will become a part of life. So Visa wants to be everywhere. They want to help you buy crypto. They want to make it easy for, you buy crypto through your Visa card itself. They want you to help to spend crypto. Means 70 million merchants now can accept Bitcoin as a payment. They want to use crypto in everyday finance. So they are working with a digital neobank. They talked about a news of how the end settlement will happen in crypto. Now, every federal bank is now creating their own digital currency. They all now Visa wants to ride that wave and say, we will give you a blueprint on how you can create a digital currency. So everyone wants to be involved. MasterCard already has patents on it. I think it was a paper or somewhere else. I also read it last week, where we talked about is they also want to be and help banks in creating digital currencies. Again, because these institutions, they understand, Visa, MasterCard, PayPal, Squares of the world, they understand that things will change, whether they like it or not, whether they want it or not. Whether it's going to be Bitcoin or Dogecoin, I don't know. Today it is Bitcoin. 15 years later, it could be anything. But this is a long running game. Don't get caught up into what's hot right now. But be aware of how things are changing across, around us. And lastly, which probably didn't get any press, but I think is very important, is Fed themselves not changing the proposed changes in the guidelines on who can have access to the Fed payment system directly. So till now, only the depository institutions, means those who can get deposit from customers, banks, had direct access to Fed payment wires. Now, they are proposing that it will not be restricted only to depository institutions. Today, there's a requirement that you need to have an FDIC insurance. So all the crypto companies, they can't access Fed payment rails, Fed payment system directly. But with these new guidelines, it will have a very positive impact on a lot of these companies. They are all getting registered in Wyoming because that's the most crypto-friendly state. They all will have direct access to the Fed payment rails. That will be great for all the crypto companies. Now they don't have to necessarily tie up with another bank. They can direct access to Fed rails. I didn't say anything, no one talking about this, but this is again a very good news in terms of crypto economy. So that's all around. I wanted to just share what I found interesting around what's happening on the crypto economy side. Let me address some of the questions now. All right. If you have any questions, yeah, keep putting in. And if you want to talk through it, that's fine. Just let me know that you want to talk through it and we'll unmute. Or raise your hand, I'll unmute you. Okay, we addressed the energy consumption already. What are the major risks involved in investing Bitcoin, Ethereum, and likelihood according to you? So I don't know. I'm assuming everyone is joining here is from US. Is there anyone outside of US? There are, depending, some countries have kind of a legally considering to ban legally. I think India is considering to legally ban holding of crypto assets. In that case, it might become an illegal activity that you're holding. So that's a big risk. I don't think they have passed the law, but there were discussions around it. The risk involved in if you're investing Bitcoin, Ethereum, is they are very volatile. Could it go down to zero? Tomorrow Doge can come in? Possible. Ethereum is a platform. We haven't talked about Ethereum in terms of what exactly it does. But Ethereum provides you a, let's say, a decentralized provide you a computing platform. There are other competing platforms available. Polkadot, Cardano, Cosmos. There are many other competing platforms. Ethereum is the first one. Will it remain its crown as king? Who knows? So do your due diligence on what each of these projects are doing. Today, 95% plus projects are running on Ethereum. That is why Ethereum has got so much value, and it has increased in the Ethereum coin value has increased in price because of the explosion in DeFi. All of them need Ethereum. Tomorrow, a better platform comes along. Some of them will switch. So those are the general risks. The other one is make sure keep your account safe, because there is no police or there is no customer care number that you can call and say, I lost my coins. If it's gone, it's gone. If someone hacks into your account or impersonate you or social engineer you and logs into your Coinbase account and move the funds to his own address, there is no way you can get it back. So that's a risk. Or says the same mining is possibly causing chip shortages. Depend on what projects are. So many of these projects, some of the can be mined using NVIDIA chips. Some of them need very specific chips. So it is possible that some of them are actually in 2017. Many of these NVIDIA chips were consumed by the miners. But later on, some of the crypto projects also changed their mining logic or mining software that you can't mine it using GPUs, which is what NVIDIA is famous for. For a beginner, what is the starting point to jump into investing into this? Study. First of all, understand the space. And then when you feel comfortable, I think this applies to any investable asset. Start small. Now, the easiest way folks start in US is through Coinbase. There are other, I'm not promoting Coinbase. I don't work for Coinbase. But most of the folks in US start on Coinbase as an exchange. It's easy. Or if you're Robinhood, now Robinhood allows you to buy crypto on their app. Or if you have a Square, you can buy it through Square. Or PayPal, you can buy it through PayPal. Just start small. When is the SEC going to approve optionable cryptocurrency ETF? What's standing in their way? So SEC has, like I mentioned, has got 8 or maybe 9. Many of these trusts keep adding the ETF applications, difficult to keep track of. But last I read was they have 8 applications. The SEC came back and told that the VanEck, was it VanEck? No, there was another one. That ETF, they're gonna move the decision over to June or July. SEC want to make sure, whatever, they have a criteria. I don't think they have shared the list, but they have a criteria on around how to protect investors. Some of them could be, number one, that there's a market is mature for it. What's the volatility in it? What's the depth in the market? How many participants are in this? What's interest? Will there be enough market makers for this? Are there enough exchanges which are willing to list these? So they'll go through their criteria, and based on that, they'll decide whether to approve or not to approve. Now, Canada has already approved Bitcoin ETFs. Brazil has already approved Bitcoin ETF. We are kind of sandwiched in between. So I hope that they'll approve it, but I don't control SEC. It's their decision on when and how they want to approve. But all I'm waiting is if they approve it, I would see a lot of other institutional investors whose charter allow them to invest in ETFs, but whose charters don't allow them to invest in these new fund technology or these the arcane assets, which is like Bitcoin. There will be many pension funds whose charter allow them to invest in ETFs. So if they have to invest in Bitcoin, they have to go back and revisit their charter, convince their board of directors, or if it is a mutually owned, they have to convince their the holders that now we want to invite into Bitcoin. But if it is ETF, a lot of that money will start flowing in. So I don't know when SEC will approve it. Barrett says, thanks. Oh, you're welcome, Barrett. So comment from Alec, but when banks are involved, it is not fully decentralized. So I have a two viewpoint on this one. Depends on how banks get involved. If bank is a gateway, but you hold your private key. So in this whole blockchain world, in the cryptography world, whoever holds the private key is the owner. Doesn't matter where you bought it from. So for example, what I do sometimes is I can create my own wallet and I have the private key. I will buy it on, let's say, Coinbase and then transfer it to my address. Because if I buy it on Coinbase and leave it on Coinbase, it's a Coinbase who holds that private key, and Coinbase give me an IOU saying, we are holding it on behalf of Vivek. What if Coinbase goes rogue? Won't happen, but just in case. Or what if I get social engineered and someone logs into my Coinbase account? So in a bank, you could buy it in a bank. And then if you are a little more savvy, move it out. But not, you could, still hold it in the bank. And then in that case, you are depending on bank. And I agree, in that case, it becomes a little bit, we are adding little centralized concept into it. But I think as people become more familiar, as people become more comfortable with this new asset class and how to deal with it, we'll figure out. And maybe there will be products on the bank website saying, generate your own wallet. And then, you create your wallet, you decide what give a string to create a public private key and all that stuff. Abe says, I thought Bitcoin is a digital currency, then why coal or fuel needed for mining? So I'll address this question. Remember how that Bitcoin gets created when a transaction is added. And the miners are rewarded, means in the ledger an entry is put against that miner's address, that they got new Bitcoins. So now thousands of computers are racing towards it to solve that mathematical puzzle. Otherwise, who has to decide who gets the reward? They are put in a competition to solve a mathematical puzzle. To solve that very complex puzzle, you need to have racks of computers. So if you really look at a miner's setup, in 2009, you could mine it on your laptop. Didn't need much computing power. Very few miners. More miners coming in. Now you needed maybe a bigger sized laptop or a desktop. More miners coming in, you need a rack of computers. More miners coming in, now you need a warehouses of computers. All those computers need electricity to run. And the concern is that many of the miners are located in area where the electricity is generated using coal. So this is specific to Bitcoin. There are other protocols in which you don't have to run and solve this mathematical complex puzzle. That is called proof of stake. Separate discussion. This is called proof of work. You have to show that you have done the work before you get the reward. Another question. I'm curious to know what's your source of information on crypto and financial news. I spend a lot of time in reading around, listening to a podcast, going through newspapers, going through, online. I don't work for a news agency, but I spend a lot of time in reading. Okay, thank you, Paul. You already explained that to Abe. Okay, Simran says it's from Australia. Okay, cool. So we got someone from Australia. Welcome. Can you explain a little on layer 1 versus layer 2? We'll talk about it. Just hold on to that. Because that gets into a little more detail of, I mean, we haven't even yet addressed the concept of, what's the issue. So anyway, let me talk about that. So this Bitcoin blockchain, this is called layer 1. Okay. Now every transaction that I do here, I want to send it to John. And let's say me and, John, I see John. Me and John, we know each other because we've been transacting with each other. And we keep sending money back and forth. So today, every time when I do it, each of that transaction has to be recorded on Bitcoin blockchain. Now, what's happening in Ethereum is a lot of these DeFi projects that are coming in, a lot of these decentralized exchanges, a lot of these lending applications, a lot of NFTs, they all are working on top of Ethereum blockchain. Remember, Bitcoin is just one application of a blockchain. Ethereum is where you can write logic. Once we have a logic, we can write a contract saying, I lend you money, you'll pay me at these intervals. So, hey, we can become lender and borrower. So all those our transactions are recorded on, let's say, Ethereum's own blockchain. More transactions coming in, more time it takes. The Ethereum blockchain is getting clogged. Capacity doesn't increase immediately. So it is getting blocked. That is why the fee is increasing. You have to tell miners, please add my transaction first so that, I get to do my work. I'll give you more fee. You will give more fee to miners so that they mine your transaction first. Otherwise, you have to wait for 10, 15, I don't know, however long that Ethereum blockchain might take. So now there are solutions that other companies are bringing in, those are called layer 2 solutions. Means, say I and John, we know each other and we keep transacting among ourselves. What we could do is we can do our transactions into a separate chain, separate layer. This is called layer 2 solution. And I start in that layer, let's say with $100. John start with $100 and we keep sending to each other. Net, I've got $40, John got $60. Only the last net transaction, I'll put it on Ethereum blockchain. So instead of putting every transaction on Ethereum blockchain and clogging it, I already know John, and we move into a separate secure room, do all our transactions, and then come back into the main Ethereum saying, now I got 40, John got 60. We only record that much. It means I've taken off the load from Ethereum blockchain. I've taken on the side chain. So there are multiple projects based on different protocols on how they operate, but this is called layer 1 or layer 2, scaling solutions. I hope been able to explain a little bit. I mean, this world is changing very fast. So, okay, Abhay, I saw you raise your hand. You can unmute yourself. Oops, I can. Yeah.
Yeah, can you hear me, Vivek?
Yeah.
I was asking about, suppose I open a Coinbase account and buy BTC or anything, will I get a private key at that time? And for every transaction, buy or sell, I have to use that private key? How this works?
No, so if you're on a Coinbase, you log in your Coinbase, you buy or sell like you buy or sell or stocks. It's a Coinbase has, so when you're a Coinbase, it's like a Coinbase use their own key and they are kind of acting on your behalf. So you don't have to worry about any of these private keys or anything. You log into Coinbase, the Coinbase will take care of it. Okay. It's just like you buy or sell.
Stocks.
When you say, yes. So when you say buy, you'll have to tell them, okay, how much USD I want to buy it? Do I want to buy at a market order or a limit order? And then you put it and they'll say, okay, bought. And then you can see that in your account, it will list BTC, whatever the number of BTCs you have. Then if you want if you want to send that BTC to someone, and then you go and say, I want to withdraw it. they'll tell you, okay, to which account you want to withdraw. You give the address of whatever. If you want to send it to your friend, you give us that address, and Coinbase will then basically do the needful. Do the needful means they'll create a transaction, they'll send it to the Bitcoin blockchain, and the ones that gets accepted, that gets mined, added into the blockchain. Then your friend, if he opens the account, she opens the account, they'll see, okay, they got the blockchain. You refresh your Coinbase account, BTC gone from your account. So as an individual end user, we don't have to do signing, etc. All these softwares will take care of us. So remember, here the machine picks up. So you only fill in the address, you only fill in the amount if you want to send it to someone. Rest is taken care by the machines.
So, but I can I take? I mean, when I sell, can I request that goes to my bank account? Money goes to my bank account.
No, so it's Coinbase like acting like a PayPal. So they'll get the money, then you have to link your bank account to your Coinbase, and then you say, okay, now I want to withdraw my USD. So when you sell it, you get the USD, and you can withdraw your USD to your bank account.
Oh, okay. It's the same like any other.
Like a PayPal.
Yes. Oh, okay, okay.
Okay.
So where did this private key concept come? So when you are showing that Mr. Nakasaki private key, when did we get that time of where we have to open the account somewhere in Bitcoin.com?
No, so whenever you have this, so all these things are automatically taken care for you. Either when you have a wallet, your own wallet. If you're on a Coinbase, then you don't have your own individual wallet. You are basically using whatever Coinbase is providing. So all that software takes care of you by generating all this.
Oh, okay.
Yeah. But the whole idea is that, for example, if I don't want to depend on a Coinbase, I want to create my own wallet. In that case, I will generate a key, and then all these management of key comes into picture.
So where do you do that? Create your own wallet?
No, I don't want to depend on Coinbase. So there are mechanisms to do it. We can talk about in subsequent sessions.
Gotcha. Okay, that's what my question was. Okay, thanks.
Next one is, how does one find out what a coin represents? Some people can spin up a coin, throw it in the desk, have 70 million valuation. Oh, absolutely. I'm seeing many projects like this. On the Slack channel yesterday, I found a coin which is called loser coin. It's created by some folks in China who lost a lot of money. I mean, that's the story. They created a coin called loser coin. And now people are actually buying that coin. This is a whole lot of a scam going on. So you got to do your own study of what this coin is, what is that they are doing, and is it even worth? I mean, in today's world where everything runs on memes, so Dogecoin was created as a joke, but when millions of people say, oh, I'm going to put a value on a joke, it becomes valuable. So I go back and look at a project and see what that project is trying to do. Is there really traction on it before I decide to put my money or time or effort in it? So Tom, how do I get a private key? So Tom, for now, just ignore it. If you're just dealing with the exchanges, you don't have to worry about any of these things. Cool, Alexis. Thank you for the info. Yep, it is ongoing learning process. I mean, I am so excited about. It's like we are watching the internet growing in early 1990s. There will be many use cases that we cannot imagine right now. And I don't want to dismiss this, saying, oh, it is slow. I mean, today, many people say that, oh, we'll never be able to use it. It's slow. 1990s, could we have imagined that we'll have a Netflix? No. But if we had dismissed internet as a technology, internet TCP IP as a technology, saying, oh, you can only send text messages, you can't even send images, what's the point? We won't, if that time, then we wouldn't have been able to enjoy the benefits of internet, what we are doing now. So that's why I'm interested in learning. in terms of what's happening in this space, and basically let's do a community learning. Too much happening in this space for any one person to catch up. So let's learn together. That's the whole intent. All right, I don't see any more questions, so I guess that's it. So thank you everyone for your time, and I'll see some of you on the Saturday session, where we'll only talk about stocks and options, and then on Tuesday, continuing our options boot camp, drill number 6, we're gonna build an account portfolio using options in a small value account. If you have, I'll take an example of $50,000. Start building an options portfolio. So all my meetups, if you're interested, come and join. It's free to attend, and I welcome. Cool. Welcome, Paul. All right, that's it. Thank you, everyone. Let's talk again in our next session. Bye-bye.